Good afternoon. My name is James C. Meyer. I am Director of the Tennessee Division of Securities and President of the North American Securities Administrators Association, NASA, the organization of the 65 state, provincial, and territorial securities administrators in the United States, Canada, and Puerto Rico. In the United States, state securities offices are responsible for investor protection and securities regulation at the grassroots level. I would like to welcome you all to the luncheon portion of the Association's annual Public Policy Day. This year's Policy Day is entitled Coping with the Crash, Public Policy Responses. NASA's response to the crash was the NASA Investor Hotline, which to date has provided assistance to more than 12,500 small investors in the United States. The hotline and the resulting report to Congress was something along the lines of a Federal Aviation Administration investigation of an airline crash. With the data collected in the hotline, NASA was able to probe through the wreckage of Black Monday in search of clues as to what went wrong and why. In addition to this major post-crash effort, it is appropriate, I think, for this association to give itself credit for raising alarm in years prior to Black Monday about the steady and alarming increase in investor complaints that were reported to the Securities and Exchange Commission, the self-regulatory organizations, and the individual state securities offices. On file of testimony from the last 5 years, it shows that we warned Congress more than 10 times that the rising tide of investor complaints indicated that all was not well with the bull market. Our luncheon speaker today, Nicholas Katzenbach, had a major role in another major project that anticipated some of the problems that led to Black Monday. Former U.S. Attorney General Katzenbach served as chief author of a study of program trading that was commissioned by the New York Stock Exchange. Starting as it did in the spring of 1987, long before Black Monday, and as the Dow was still on its way to topping 2,700, the Katzenbach study attracted little early interest in the press or policy-making circles. Of course, this was a point in time when few Americans had any notion of the meaning of the term program trading. The study commissioned by the New York Stock Exchange was a far-sighted and, in retrospect, clairvoyant effort to probe the consequences of program trading and the frightening prospect of a market meltdown. In a sense, the Exchange's study and Mr. Katzenbach's efforts illustrate what the NASA Public Policy Day is all about: the encouragement of progressive and anticipatory reforms that are needed to appropriately address problems in the market before disaster could strike again. I am honored to introduce our luncheon speaker, former Attorney General Nicholas Katzenbach.
Thank you very much, Jim. When I did the study which Mr. Meyer referred to for the New York Stock Exchange on program trading late last year, it was the first concentrated look at the market which I had taken in many years. And I confess I didn't like everything that I saw, or at least that I thought I saw. And while my focus was on program trading, essentially the linkage between futures and present values, or cash in the investment market, or Chicago and New York, or the SEC and the CFTC, you can take your choice. It was other aspects which attracted my interest and curiosity. To put it succinctly, it was the change in market philosophy and perhaps function which surprised me. While I'd read about program trading and triple witching hours and volume growth and the growth of funds and the creation of futures and options and computerization and so forth, I'd never attempted to see all these as one, to put them together in an overall framework. And having less knowledge and experience than this audience, I'm still not sure that I can. But I do want to share with you some concerns, and whether they're real or not, I simply don't know, but I leave it to you to judge for yourselves. Securities markets exist for the purpose of facilitating the infusion of capital into business by way of both equity and debt, and into government by way of the latter. And the creation and maintenance of markets in which such instruments can be easily and quickly bought or sold at modest premiums or discounts facilitates investment and ultimately the attraction of new resources into business. In a reasonably free and liquid market, values are competitively measured by the demands of many buyers and sellers for a variety of investment instruments. And thus the markets traditionally have served to allocate quite efficiently investment based on the estimates of comparative returns after taking into account a host of variables. My premise is that that function is as important today as ever, and that the changes which have taken place in the past 2 decades, the increasingly institutional nature of investors, growing role of professionals with huge funds at their disposal, the internationalization of markets, the growing complexity of investment instruments have not invalidated that function. Many of the players are more sophisticated. Computers measure the financial significance of information and small monetary differences quickly and accurately. And competition for savings and investment has become international. Nonetheless, we're still talking about the efficient allocation of money into business and government, and we continue to depend on competitive market forces and the relatively free flow of information to do so. Now, I state these familiar and time-tested fundamentals simply to make sure that it's that ball that we don't lose track of as rapid change born of both social and technological developments occurs. The conceptual market, the conceptual model of those markets, and close to actual fact until perhaps recently, has been a number of individuals or trustees on behalf of individuals seeking appropriate investments for different portfolio objectives and needs, with the intention of holding those investments for substantial periods of time, usually measured in years, with periodic minor adjustments geared primarily to either to business developments or a personal change in circumstance. To facilitate liquidity, specialists and market makers existed, and brokers could buy or sell for their own account. Tax laws, through capital gains rates, encouraged holding for 6 or 12-month periods at least on the part of investors, and the relatively high cost of trading due to fixed commission rates served to discourage efforts to realize short-term gains, and so did the relatively high margin requirements. The growth of institutional and foreign investors, coupled with deregulation, especially competition with respect to commission rates, and regulatory approval to trade options and futures, has had several obvious effects. One is the capital growth and consequent growth of trading on all exchanges. The other is the growth of very large block trades and mechanisms to facilitate them. And the third, and perhaps less obvious effect, is the extent to which trading has supplemented and succeeded investment, and short-term profit objectives have supplemented and replaced long-term considerations. And it's that third effect which concerns me most. Over long periods of time, prices of particular stocks are affected vis-a-vis other stocks by corporate performance. But in the short term, prices of all stocks are most likely to reflect macroeconomic judgments about the state of the economy as a whole, rather than simply different predictions about future earnings of particular companies. And anyone who focuses upon investment as traditionally understood, looking for long-term results with a horizon of years, is looking for underpriced stocks, which over time will increase their value. And anyone who seeks results in the short term must, of necessity, focus on macroeconomics, the state of the economy here or in other countries on a day-to-day or hour-to-hour or minute-to-minute basis, particularly if he's managing a large and diversified portfolio. Because pension funds and often individual investments are, for reasons of prudence reinforced by law, broadly diversified, and it's difficult for any fund in the short term to do better than the market as a whole, measured by some appropriately broad index, such as the Standard & Poor's 500. And while professional investors undoubtedly continue to seek underpriced sleepers, not only does so much professional attention make such stocks rarer, but fund managers are under increasing pressure to show performance in the short term, a requirement which virtually compels them to achieve trading profits. While this trading may well contribute to liquidity, that's really not its objective. The objective is to profit from short-term swings of the market as a whole, an objective which, frankly, I find difficult to distinguish from speculation. The markets in index futures contribute greatly to this short-term focus. Since settlement is in cash, they are not really by definition markets for investment. They do provide some liquidity. How much and how effectively, I have some reservations. And undoubtedly, they are useful to fund managers for hedging purposes. But after all that is said, they remain, in my view, highly speculative. Perhaps more important is the necessarily short-term focus which aids and facilitates a trading philosophy. Today, fund managers control just under 40% of the investments made, but over 80% of the trading is done by that 40%. For the most part, there are no tax consequences at all. They can realize huge leverage in the futures markets. They use volume to facilitate block trades cheaply and computers to do it quickly. No individual investor can possibly engage in comparable activities. Perhaps that's a good thing. But I suggest that large volumes of trading may be scaring individual investors out of the investment market, and that 40% may soon be 50% or 60%, and volumes of daily trading may soon average 3 or 4 or 500 million shares. Does that make any difference? I don't know. There's some risk, it seems to me, that increased concentration on trading will jeopardize the traditional allocation function of the markets, and with internationalization, allocate money to national economies through index funds rather than investment in selected companies, all done in accordance with macroeconomic factors. There's some utility to that allocation, but it may increase the cost of new investments by small companies and new ones, companies not incorporated in popular indices. And thus it may serve to concentrate further capital investment in large companies, companies familiar to foreign investors, which are included in virtually all the national indices. And yet large companies are rarely the most innovative and not always the most efficient. There is, too, another consequence. While economists worship at the altar of the god liquidity and argue persuasively from massive statistics that the more perfect and free the market, the less its volatility, I really wonder. I think that liquidity is often a fair weather liquidity, and that the new financial products encourage large speculative positions on the assumption that those markets permit those positions to be unwound rapidly. That certainly didn't occur on October 19th. And I believe generally that the result is wide swings in prices, particularly intraday prices, and that the truly disastrous falls of last October have become more likely than in the past. Problems, whether they're political or economic shocks, can turn what would otherwise be a ripple effect into waves all around the globe. Now, there are obvious advantages to deregulation and internationalization, but there are consequences too, particularly in a world in which national economic policies are not coordinated to take account of the international financial environment which already, in fact, exists. And frankly, what concerns me the most, though, is the enormous amount of intelligence, energy, and money concentrated in what I think of as largely unproductive endeavors, not contributing to national prosperity, not contributing to GNP. I say largely because there's no question that promoting and facilitating investment does contribute. But trading is a zero-sum game. And does ever more liquidity attract ever more investment? Is increased liquidity beyond a certain point really important? I fear, too, that earning large sums of money in this fashion can sometimes be corrupting. Always seeking the edge, constantly subjected to enormous pressures, dealing with truly huge sums of money. We've seen some of this in arbitrage activities, using improperly inside information. There may be more front-running than we can easily see, particularly given the interdependence and interconnection of differently regulated markets. And surely greed is a factor in the acquisition mania that we're experiencing. Let me just say a few words about that phenomenon, because I think it does affect the markets. Again, I have enormous admiration for the ingenuity and creativity of those who wheel and deal in buying and selling multi-billion corporations like apples and oranges. And I accept that this activity sometimes has had useful and productive results through the redistribution of productive assets to companies where they can be more efficiently employed. That's by no means always the case. And again, it's a force for economic concentration, which I suppose in the abstract can be either good or bad. My difficulties primarily stem from intense skepticism that loading corporations with debt is an intelligent national policy which will make us more competitive internationally. And of equal importance, the tax laws, probably inadvertently, encourage debt as an acquisition device. We tax corporate profits, but we allow corporations to deduct interest payments and debt. As mergers involving leverage buyouts proceed, corporation after corporation is disappearing from the tax rolls as its cash flow is increasingly used to pay off debt, or, which is worse, paying off debt only in an accounting sense, such as with zero coupon bonds. All manner of ingenious new debt instruments are being created and purchased, with what consequences God knows. As Warren Buffett recently remarked, if Mexico had discovered zero coupon bonds soon enough, it would be current in its payments today. And in fact, it's exactly that kind of device which is being suggested by many to sweep difficult political and economic problems under the rug. Indeed, the very internationalization of markets makes possible far more questionable governmental policies, because with so much more money involved, it takes a much longer time for market discipline to assert itself. After all, it's foreigners who permit our debt today, and it was largely Americans who made possible Mexico's yesterday. Now, my purpose today has been not to provide answers, but to share some concerns with you. I don't have any great wisdom on what may be fundamental problems of importance. Perhaps they aren't even the problems that I think they are. I would feel mightily reassured if people in government and industry were analyzing these problems in a broad way and either dismissed them or recommended solutions. Some problems and some solutions seem to me fairly obvious. Whether we as a society opt for more or less regulation, there's absolutely no sense at all to two regulatory agencies, two different sets of regulations controlling related markets. I recognize the political difficulties in consolidation, but do we really need another October 19th to make such an obvious point? Second, we need a level playing field from a regulatory point of view.